Welcome to The Explainer. You know how we do it. We take big, complicated ideas and make them easy to understand. Today, we're tackling an absolute cornerstone of modern finance, the capital asset pricing model. So let's just jump right in with the one question that every single investor has to ask themselves when you're about to buy a stock: how in the world do you know if you're getting paid enough for the risk you're taking on? I mean, what even is a fair return? Well, to answer a question like that, you need a solid framework, right? A way to think about this crucial trade-off between risk and reward. And today, we're going to unpack the most famous one out there, the capital asset pricing model, or as pretty much everyone calls it, CAPM. All right, let's get into it. First things first, we've got to define what we're actually talking about here. And to make this all feel a bit more real, let's use a company I think we all know, Apple. Okay, so for anyone who owns a stock, the return you get isn't just one single thing. It's actually a combo of two different things. First, how much the stock price itself goes up or down, and second, any cash dividends the company decides to pay out. Simple enough, right? That's the reward side of the coin. Now take a look at this. What's absolutely fascinating here is just how messy it is. The return for an Apple shareholder is not some nice, smooth, predictable line. No way. It jumps and dives all over the map. I mean, look at that. Some months, investors made over 20%. In others, they lost almost that much. And this variability, this wild swing, well, that brings us to our next big idea: risk. You see, in the world of finance, risk basically is this volatility. We use a fancy stat called standard deviation to measure just how spread out all these possible outcomes are. But don't worry, you don't need to be a math whiz to get the big idea here. Because here's the twist, and it's a huge one. Not all of this risk actually matters to a smart investor, not even close. And that right there leads us to one of the most powerful concepts in all of finance, something you've probably heard of: diversification. People often call it the only free lunch you can get on Wall Street, and for good reason. So here it is. This is the free lunch. When you mix a bunch of different stocks together into a portfolio, your expected return is pretty straightforward. It's just the weighted average of all the individual stock returns. But the risk is the magic part. Your total portfolio risk is actually less than the average risk of the stocks in it. So how is that possible? Why does that happen? It's actually pretty intuitive when you think about it. When one company in your portfolio is having a terrible month, another one might be knocking it out of the park. Their individual ups and downs, their good news and bad news, they start to cancel each other out. And here's the key takeaway from that. Since any smart investor can easily get rid of these company-specific risks just by diversifying, the market isn't going to pay you a premium for taking them on. Why would it? Okay, so this raises a really big question, right? If there's a whole category of risk that's basically irrelevant, the stuff you can just diversify away, then what's the risk that you do get paid for? What's the risk that actually matters? It all boils down to this really important distinction. The market won't compensate you for taking on diversifiable risk, things that are unique to a single company, like a product launch failing. You get paid for taking on the risk you can't escape, the big stuff, the non-diversifiable risk that hits the entire market, like recessions or changes in interest rates. Okay, so what we need now is a single number, a way to measure how sensitive any given stock is to these big, unavoidable market-wide movements. And you can see it right here. Even though Apple's returns are way more volatile, you can tell its ups and downs are definitely related to what the overall market is doing, which we're showing here with the S&P 500. And that number is beta. And honestly, beta is kind of the hero of this whole story. It's the one number that tells us exactly how much of that non-diversifiable market risk a stock is carrying. A beta of 1, that means the stock moves pretty much in lockstep with the market. If it's greater than 1, it's more volatile. And if it's less than 1, you guessed it, it's less volatile. So how do you get this magic number? Well, you calculate beta by looking at a stock's volatility compared to the market's, and then you multiply that by how closely the two move together. That's the correlation. It's a really clever calculation because it isolates the only risk that a diversified investor should care about, that systematic market-wide risk. All right, so now we have our perfect tool for measuring the right kind of risk. We have beta. So we're finally ready. Let's put all these pieces together and build the full capital asset pricing model formula. At its core, the CAPM formula is really just a simple logical sentence. It basically says the return you should expect from an investment is built from a couple of key parts. First, you get a baseline payment just for the time value of your money for waiting. Then you get a bonus on top of that for taking on market risk. And that bonus? It depends on two things: how much market risk you're taking on and what the market's current price for taking on that risk is. And that simple idea translates into what is truly one of the most elegant and powerful formulas in finance. The expected return you're looking for equals the risk-free rate plus the stock's beta times something called the market risk premium. So let's stop talking theory and actually use this thing. Let's calculate what a fair return for holding Apple stock should be right now. Okay, time for the payoff. We're going to plug in some real-world numbers for each piece of that formula and figure out Apple's cost of equity, which finance folks just call KE. First up is the risk-free rate. Remember, this is our payment for just waiting. It's the return you could get on an investment that's considered to have basically zero risk. For that, we almost always use the yield on a 10-year U.S. Treasury bond. Next, we need the amount of market risk that Apple carries. And we know what that is now, right? It's the beta. Apple's beta comes in at 1.2. So what does that mean? It means it's considered to be 20% more volatile, more sensitive to those big market swings than the market as a whole. And last but not least, the market risk premium. This is that extra return investors as a whole demand for investing in the stock market instead of just sticking with those safe, risk-free bonds. It's literally the price you get paid for taking on 1 unit of market risk. Okay, let's put it all together and see what we get. We take that risk-free rate of 1.56%, we add Apple's beta of 1.2, multiplied by the market risk premium of 5.40%, and drumroll please, we get a cost of equity for Apple of 8.03%. And there it is. According to this model, that is the minimum annual return an investor should reasonably expect to get for taking on Apple's specific level of market risk. So let's just pull this all together, shall we? What's the big takeaway? First, risk is volatility, but not all risk gets you a reward. Diversification is your free lunch. It wipes out all that company-specific noise. The only risk you actually get paid to take is that non-diversifiable market risk, and we measure that with beta. And that's the whole point of CAP. It gives us a universal language, a clear formula to connect that specific risk to an expected return. And the model is so adaptable that for emerging markets, you can even tack on a country risk premium to make it even more precise. So there you have it, the capital asset pricing model. It's this incredibly disciplined framework that takes a fuzzy, abstract idea like risk and turns it into a hard number. And it really leaves us with a final question to chew on. Now that you've seen how Wall Street puts a price tag on risk, how is that going to change the way you value it?